Good afternoon, ladies and gentlemen. Welcome back on day 4 of our webinar series taking place over this week. I would like to remind you that you're able to engage with the panel today using Slido, which you will see on the right-hand side of your screen. You will be able to submit questions for the Q&A and participate in polls created by the panel. It now gives me great pleasure to introduce Montserrat Farina, Executive Director, JP Morgan Chase, and Chair of AFME's Digital Asset Task Force, and her panel, who will discuss creating legal certainty for crypto assets.
Thank you, Emmanuel. I am delighted to be here today, virtually with all of you, and fortunate enough to be joined by
Apologies, we seem to have lost Montserrat Farina. If you could just hold your screen while we work through the technical issues. Thank you.
So did you? I don't know exactly where I disconnected. I was trying to introduce the panel. So here with us we have John Whelan, Head of Investment Banking at Santander, Lexo Collins, CMO and Global Co-Head of FinTech at Consensus, Radoslav Albrecht, Founder and CEO of Bitbond, Stephen Lightstone, Associate at Morgan Lewis, and finally, Peter Silgalvis, Head of Unit Digital Innovation and Blockchain at the European Commission. I would start by saying that the views expressed here today are just my own and not those of JP Morgan. During the session, we will be discussing benefits and use cases of distributed ledger technology and crypto assets, what the market may need to develop further from where it is today, the opportunities and risks that digital money and central bank digital currencies may bring, and finally, the impact that all of these may have in the financial system as we know it. I know these topics may bring a number of questions from the audience. As Emmanuel said, you have the opportunity to send them during the session through Slido, and we'll try to cover as many as possible at the end. Distributed ledger technology and the assets created with it, or crypto assets, have the potential to change existing processes and bring new ways to do things. It could enable markets to operate 24/7, 365 days a year, and reduce the inefficiencies and frictions arising from manual inputs and multiple reconciliation efforts, particularly in post-trade. Errors and subsequent disputes could decrease, and the risks involved in these processes could be lessened by comprising settlement times. This would also release capital that is now tied in those long settlement cycles. However, the appropriate configuration of settlement in this environment would need to be evaluated carefully, depending on the needs of the market and the effects on the system. If we start with what the technology has been used for, so far I have seen it in securities markets used in both issuance, syndicated loans, repos, commercial paper, and issuance of shares for small and medium-sized companies. Within payments, it has been used for trade finance and bank guarantees, and also to issue digital currencies such as stablecoins. But why to use distributed ledger technology versus something else? What does it bring that is incremental and different from traditional systems? Personally, I think that one of the most interesting use cases is the promise of automated conditional payments or programmable money, including its usage on the Internet of Things. Collateral could move faster and cross-border, and the technology, combined with broad implementation of digital identities, could lead to automated processes end-to-end. If I can now turn to John and then Lex, what do you see as the most significant benefits of using distributed ledger technology in payments and capital markets, and what exciting projects have you seen recently?
Thanks, Montserrat, and great to see everybody again. I think our work is bringing us forward more rapidly maybe than we anticipated. I think the most interesting use is what you alluded to already, which from my point of view is programmable digital value, which to a large extent does not really exist today. You could argue that securities, they're not quite digital, they're electronic today. The same could be said about payments. Payments are not quite digital, they're electronic. But if you can use the power of programmability that is inherent in distributed ledgers or blockchain technology, that leads us to a point where you can actually embed behavior into the security or into the payment or into the money itself. And I think the story has yet to be told. I think what we're doing at the moment is really examining where we can bring efficiencies to existing business processes. And I think there's a huge amount of work to do there. But beyond that, it'll be a future of programmable digital value in ways that we cannot even imagine today.
Lex, what is your
Absolutely.
perspective?
Nothing to disagree with. All good things, and sometimes it's helpful to re-anchor in what's exciting about the theme, because often we just talk about the theme, right? So the idea that you can have scarcity of digital assets, you can have authentic assets that are digital first. Like if I were to give you an apple, you would have it in the real world. If I were to give you a picture of an apple, you would have it and I would have it, and therefore we can't have economic exchange. But if that picture of an apple were anchored to a blockchain, then I can transfer to you the ownership, to the access to that picture, and you would have it, and we can have markets, we can have trade settlement, we could have exchange, we could have payments, we could have derivatives, whatever it is that you like. And so this authenticity and kind of digital scarcity is really important. And the second point around programmability is also, it's like easy to say, but I think really takes a long time to seep in. It's a computing platform. The way the phone is a computing platform, the blockchain network is a place where you write software, and so we can go through the use cases, but it's these core innovations in the structure of the manufacturing of financial product that matters. If I were to land on some specific things that I'm excited about, CBDCs are projects that Consensus is working on very actively. We're working on a project in Thailand, in Australia, Hong Kong, and France. And so that's a strong area of interest. And then, of course, global trade and capital market settlement projects are really important to us as well.
Indeed, some of those are really exciting opportunities for the technology. Now turning to Patrice, can I ask you, what is the Commission's view today on the potential of distributed ledger technology, and what key initiatives are you driving within DG Connect?
Well, we're very enthusiastic about these technologies and have been since the FinTech Action Plan in 2016, and actually before that. We see obviously some risks related to them, like with any technology or with any market, but overall we see the positive opportunities. So we've moved to set up this EU Blockchain Observatory and Forum, which is a way that the knowledge and the evidence base. There we had a workshop recently, which might be interesting to the listeners. It's recorded and online, on central bank digital currencies with the ECB, the Bank of Japan, and the Bank of Canada. Then we have a European blockchain partnership of 29 countries, all 27 EU member states, Norway and Liechtenstein building, not piloting, but deploying use cases such as self-sovereign identity, RegTech, regulatory reporting, audit documents and diplomas on a blockchain infrastructure, where justified. We're not carried away by the hype. And then there are legal framework initiatives, which I think we'll touch on a little bit later, markets in crypto assets, pilot, as well as work to ensure that we have a full digital single market and no fragmentation for the use of smart contracts across the whole EU. And then there's also the standardization world, where we're active in International Standardization Organization Technical Committee 307 as well, to ensure there's not barriers to entry for our SMEs, startups, and others to utilize blockchain technologies in Europe.
Thank you, Patrice. If we now focus on what the market would need to develop from where we are today. From my perspective, legal certainty and regulatory clarity are key elements for this market to take off. Based on that, I think the crypto assets proposals published by the European Commission are a step in the right direction, as the EU is taking a global lead on these topics by adopting a comprehensive framework that is directly applicable across the Union. I think this has the potential to influence the global agenda, as we shouldn't forget that this is a global market. So collaboration and coordination is key, particularly relating to the work done on interoperability and cross-border transactions, which also links with the standards that Peteris was referring to. For those not familiar with the EU package on crypto assets, there is a proposal for a regulation of markets in crypto assets, or MiCA, and another one on a DLT pilot, which is an EU-wide sandbox for trading venues and central securities depositories. MiCA tries to bring into the perimeter of regulation currently unregulated crypto assets and crypto assets activities, and in particular, stablecoins. The pilot tries to support innovation and allow the market to develop by permitting the issuance, trading, and settlement of some securities using distributed ledger technology, and also by allowing some exemptions from current rules. If we look at the market, there are different definitions of crypto assets across jurisdictions and regulators. So there have been some calls from market participants to create a crypto asset taxonomy that is, if possible, globally consistent. So, Stephen, now turning to you, I would like to ask you, what is a crypto asset taxonomy, and why do policymakers and market participants need one?
Thanks, Montserrat. So crypto asset taxonomy is a set of classifications and definitions for individual types of crypto assets. So market participants and policymakers dealing with crypto assets need at least some sort of defined categories of crypto assets so as to know how a specific crypto asset is treated for regulatory, tax, or other purposes. And the granularity of a taxonomy needs to be balanced between giving, on the one hand, clear classifications so as to give certainty on what legal framework a particular crypto asset falls into, and on the other hand, allowing flexibility for change as market structures develop and technology changes. And as Montserrat indicated, there's currently no common global crypto asset taxonomy. But the proposed EU MiCA regulation aims to harmonise the categories of crypto assets for regulatory purposes, at least across the EU. And so, for instance, the proposed regulation defines crypto assets and classifies those that are covered by the regulation into the categories of asset reference tokens, which are tokens backed by commodities, fiat, or other crypto stable coins, utility tokens, which are tokens that provide digital access to a good or service available on digital distributed ledger technology and only accepted by the issuer of those tokens, and e-money tokens, which are tokens the main purpose of which to be used as a means of exchange and that purport to maintain stable value by referring to the value of a fiat currency. And in the UK, the FCA published its final guidance last year to provide clarity to market participants on the types of crypto assets that fall within the regulatory perimeter in the UK, dividing crypto assets into the categories of security tokens, e-money tokens, and unregulated tokens. And in terms of stablecoins, the FCA made it clear in its guidance that they were inappropriate for any single classification and could fall into any category of security, e-money, or unregulated tokens, depending on their specific characteristics. And so it'll be interesting to see whether global taxonomy is adopted and how the proposed EU taxonomy will develop.
Yeah, and picking up on that, John, if I can now turn to you, what form should a taxonomy take? Is it at all possible to be granular and future-proof at the same time?
So that's a good question. I like a taxonomy that is comprehensive, concise, and simple. I'm a practitioner. I work in a bank, but I'm really an engineer, and as such, having a taxonomy that is easy to work with, that doesn't require a lot of explanation, I think is very helpful. We've had internal taxonomies, or a taxonomy we've been working with for the last 3 or 4 years that we update from time to time as new developments occur. I think the best one that I've seen, and one that I've had an opportunity to work on myself a little bit through AFME and also the GFMA is a taxonomy that a lot of thought went into, that was prepared by the financial industry to kind of define the space as we see it today. Now, it's already a few months old, and there's probably some tweaking and some updating. But honestly, from the different flavors that I've seen and the evolution of these things, there are a couple of really good kind of starting points that already exist. We definitely do not need to reinvent the wheel. There are basic things such as, cryptocurrencies. What are those? Well, we know the Bitcoins and the Ethers and the XRPs of the world. Okay, fine. We've got a variety of stable value crypto assets, CBDCs, stable coins, FMI tokens, bank issued depository tokens. We've got a variety of tokens that can represent financial instruments, whether those financial instruments are securities, non-securities, loans, bonds, equities, derivatives, etc. And then we have a variety of let's say utility tokens or platform access tokens, things like digital collectibles, whether that's in-game components of video games or digital art, etc. And there's a fairly logical series that you can go through to actually define all of this stuff. I don't think we need to reinvent the wheel at all.
Yeah, and the taxonomy that John is referring to has been published as part of the GFMA response to the BCBS consultation on the prudential treatment of crypto assets, so it can be accessed publicly. Patrice, MiCA refers only to some types of crypto assets and does not provide a comprehensive taxonomy. Could you comment on the Commission rationale to take that partial approach?
Gladly. I mean, the Commission tries to be useful here. If it was ever true that if it moves, the European Commission regulates it, it's not true now, and it wasn't true in this case. As I said, there are at least several and quite a few people following blockchain and cryptocurrencies starting in 2012, 2013, and undertaking a lot of initiatives in this area already around 2015, 2016. So we've watched the market develop, we've watched the technology develop, we've talked to stakeholders. And actually, so what we tried to do with the MiCA was to fill the gaps. We see that investment tokens come into MiFID II, tokenized equity or bonds. We saw that payment tokens partially came into the e-money directive, but that there was a gap there, but that utility tokens, which were already mentioned, were not regulated per se. You could say they came under e-commerce and they came under consumer protection. So saying that they're completely unregulated was not true, but there was not a regulation that people had to say recognize themselves in if they were issuing a utility token for a decentralized ecosystem. And then for the stable coins, or as we call them, asset reference tokens, this was also missing. So we addressed it in MiCA. So we tried to make sure that there's no gray areas anymore. This is also a demand of the stakeholders. They didn't want to be in a shadow economy. They wanted to be a legitimate part of the economy and be able to get bank accounts, to be able to talk to investors. So with this, we think we have a regulatory framework that covers everything, either in existing or in the new legislation, and at the same time that it's risk-based. So we're not piling all the requirements for a security on top of something that is not a security. But at the same time, also, if we look at the stable coins or asset reference tokens, there's also a risk-based approach that something which is smaller, experimental, or niche is not causing a large risk to the financial system or to all consumers, but at the same time, something that is globally significant is welcome in our open market, but should be supervised more closely.
Thank you, Patrice. If I can now move to Radoslav. From your perspective, do you think that the EU is doing enough to promote crypto assets and innovation? And if not, what else should be done?
So my take on this is, first of all, already today, under the current legal frameworks of many EU member countries, you can issue tokenized securities, you can conduct business in cryptocurrencies. So crypto assets are already usable today. However, of course, there are relatively big differences in the legal frameworks from one country to another. If you compare Germany with France, with Luxembourg, you will find that different regulations apply to several types of crypto assets. Last year at Bitbond, we issued Germany's first tokenized security, which received approval from the German financial regulator BaFin. And we did that by writing a prospectus that is in compliance with EU prospectus regulation. And we found a way to dematerialize the security under the current legal framework. So there are ways to issue crypto assets already today. However, of course, we did this in a way that it was possible to do it in Germany. Probably a very similar approach would have been possible in Luxembourg, but many other countries, it may not have been possible to do it the way we did it. Therefore, it is really important that the EU is taking action and is starting to harmonize regulation that applies to crypto assets. And again, this includes all types of crypto assets. This includes stablecoins, payment tokens, utility tokens, as well as cryptocurrencies, and of course tokenized securities, or in general financial assets that are dematerialized. Is the EU doing enough? I think it's really important that MiCA and the pilot regime have now been released, and I think they are going in the right direction. I think as a next step, what needs to be done is there needs to be a discussion whether the proposals as they have been released now fit the requirements of the market participants, but this is exactly what's happening right now. And then, of course, there needs to be a reliable time frame so that the market participants can see as to when these harmonized regulations will actually be implemented. And I think this is kind of the optimal approach. And a lot of that, or almost all of that, I actually see happening. So my take on that question is, yes, the EU is doing enough. Maybe sometimes you wish things could be going faster. But I mean, we have a very pluralistic society in different countries with different legal backgrounds. So it's definitely not a very easy and straightforward process. So I think the EU is on a very good way, to be honest.
Thank you. I agree that having a regulation that is directly applicable across the member states is definitely the way forward, as it's going to allow for harmonization and avoid regulatory arbitrage between different members. If we look at DLT, it has been around for a number of years now. However, it is not yet mainstream. Continuing with you, Radoslav, what do you think could be a tipping point for DLT to achieve scale in financial services?
I personally believe that there won't be one tipping point where, first of all, we have flat growth, and then all of a sudden we have exponential growth in the use of DLT. I rather believe it will be more of a boring linear type of growth. And the reason for that is a lot of relatively big and established financial institutions will need to adopt this technology in order to be used at a wide scale, and that simply won't happen overnight. If you look at the change processes, not just in asset settlement, but in general, when it comes to technology at large-scale financial institutions, then these simply take a lot of time, and they won't all happen in parallel and at the same time. What it takes in order to increase the level of growth in the use of DLT compared to what we see today is to have 1, 2, maybe 3 larger of the mainstream financial institutions in Europe to start adopting the technology. But I already see that happening today. At Bitbond, we just started a very large-scale project with one of the largest banks in Germany in order to help them prepare an implementation of DLT in their securities settlement business. And this is not a small bank that is doing an issuance per month, perhaps, but they issue hundreds of products every month. And if they made the switch from a legacy infrastructure to a DLT-based infrastructure, then what's going to happen is that other market participants that are playing in the same ballpark as this large bank will say, wow, these guys have managed to accomplish that. We should do something similar in order not to be left behind. So I think it takes 1 or 2, maybe even 3 large-scale financial market participants to make that switch. and then many others will follow. Again, it won't happen overnight, but I think this could spark a bit of a faster growth compared to what we do have today. But I see really good signs from the market, not just from this one bank, but also from several others, to be going in that direction.
I couldn't agree more. I think that the real impact on our lives will come when critical mass is reached due to network effects. So from my perspective, the real opportunity starts when you're having a sufficient number of intermediaries in a shared ledger infrastructure that would allow to do payment versus payment or even delivery versus payment. That will change the dynamics, in the financial infrastructure as we currently know it. Lex, if we now try to look at the near future, how do you think that the crypto asset landscape will evolve in the next 2 to 3 years? What is your view on whether distributed ledger technology will ever replace existing systems and financial infrastructure?
So I think just by wearing the consensus T-shirt and being the closest to crypto assets on the public chains, I sort of have to make these points. I spent a meaningful amount of time at companies like Barclays and Lehman and Deutsche Bank, so I fully understand the linear point of view, but there's just no way this is linear. There's just no way, I think, and it's like there's 50 years of artificial intelligence, and it's just math and textbooks, and then within a span of 10 years, all ATMs are dead, all banking happens in the phone, Apple is worth $2 trillion, and banks collectively in their market cap are less than that. Right? Like, so this is one of these things. This is one of these platform shifts that is super fundamental. So the best thing you can do is to bring curiosity to this theme and to say, if there's a black swan event like COVID, where all of a sudden no longer are we doing anything but Zoom, then you have to figure out how does this run, how does finance run on it? So if I were to bring that back, let's say we're now in a world where 80% of the Chinese economy and the entire Belt and Road Initiative is on blockchain controlled by the Chinese government. I don't think it's a linear intermediary process to convert folks into permission DLTs. I think it's a national geopolitical race to deploy global central bank digital currencies and programming environments for modern financial infrastructure. Is that good or bad? I don't know, but I just want folks to sort of have that excitement in them. In terms of the next 2 to 3 years for the crypto asset landscape, I think on the enterprise side, we're going to see kind of continued consolidation between enterprise Ethereum and Quorum, R3 and Corda, and likely Fabric around global trade, around capital markets, and around payment networks. And increasingly, what I would expect is for the public blockchains to be used as the networks. They're in many ways cheaper, in some ways more performant, and I think we'll see companies starting to experiment using public blockchains that are cheaper to run than consortia. And then if you look at the public blockchain already today, there's about 20 billion of US dollar denominated cash equivalents that are traveling on Ethereum. There's about 15 billion of collateralized lending and exchange that's going on. And so I think this theme is actually further along than it may feel. And that is both a scary thing, but also a very good thing for folks who want to do innovation in the space.
Those are interesting statistics and also very provoking thoughts. If we now change the topic slightly, since the Libra announcement last year, there has been an increased interest and focus on digital forms of money, from stablecoins to central bank digital currencies. Bahamas has just launched their digital currency, and there are a large number of central banks that are either conducting pilots or experimenting with digital currencies. China has launched a pilot in several cities, as Lex was referring to. The Fed is experimenting with the MIT, and Canada is close to launch. Here in Europe, the Bank of England has consulted on a retail central bank digital currency, and the Eurosystem is also asking for feedback on a digital euro. So, Peteris, what do you think will be the potential impact of current CBDC initiatives on the market?
Okay. Well, on our side, as I say, we're building a blockchain infrastructure between the member states right now. Something that inevitably we'll need is to pay for certain public services as a public-private partnership comes into play. So we have a very pragmatic interest in our infrastructure project and the regulatory sandbox of the possibility of having a digital euro. The ECB just released its report setting out the criteria when such a digital euro might be introduced. And as I mentioned, we had this central bank digital currency workshop of the European Blockchain Services Infrastructure together with the Bank of Japan, Bank of Canada. So again, with an international outlook, we're thinking about this. From the side of the Commission, once a decision has been made by the ECB and the governing board, it is of course interesting for us as being responsible for the international role of the euro that looking to this future, which and I think I can only agree with some of the projections that were being made, that we could have a programmable token-based digital euro that could enable machine-to-machine transactions, manufacturing 4.0, a lot of the exciting things that we're aiming to enable in Europe in the digital single market and in the digital single market of the future, also in the convergence of technologies, artificial intelligence, IoT, big data, and blockchain. So this is something there will be a decision by the monetary authorities, but we're working with them and we're providing them with our inputs on the different options that could be available that ensures that the euro is not only important today, but that it is a leading currency of the world also tomorrow.
Thank you, Pedris. Stephen, from your perspective, what do you think will be the impact of the announcement of stablecoins such as Libra on crypto assets regulation?
So as many crypto assets currently fall outside the scope of regulation, subject to regulatory requirements, the announcement of global stablecoins has attracted the attention of regulators around the world and raises challenges in terms of investor protection, market integrity, and financial stability. And while the crypto asset market is still modest in size and is not currently deemed to pose a threat to financial stability, regulators are concerned that this could change with the arrival of global stablecoins. And so many regulators are either developing regulation that covers stablecoins or are considering whether specific regulation for stablecoins is required. And given also the global nature of stablecoins, they're likely to force cooperation, at least to some degree, between regulators. And it looks like the regulation of stablecoins in certain jurisdictions is being tightened. And so, for instance, the proposed new EU rules introduce a new supervisory framework to oversee the development of stablecoins that could potentially have an impact on financial stability and require stablecoins designated as significant to be supervised by the European Banking Authority. However, governments are facing the challenge of striking a balance between providing a minimal regulatory framework that boosts innovation and, on the other hand, ensuring market stability and adequate consumer protection. And the Bank of England's Governor, Andrew Bailey, told a European Central Bank panel discussion just last week that he did not think that privately operated stablecoins such as Facebook's Libra were suitable for widespread use or could be trusted as a safe store of value like many traditional currencies, and said that the answer may be a central bank digital currency that provides guarantee and certainty of value. And also the UK Treasury has promised to put in place regulation to control the use of stablecoins. And so we wait to see the extent to which other regulators also propose to regulate stablecoins.
Thank you. Those are interesting perspectives indeed. Lex, central banks seem to be mainly focusing on retail central bank digital currencies. From your perspective, could wholesale CBDCs bring any value versus what we have today?
Yeah, absolutely. I think we see projects that are both retail and wholesale, and I think the architecture specifically for wholesale is a bit more achievable in the short term, a bit more straightforward, and I think the coordination required to develop that type of network is also less disruptive to the existing value chain. And so in this way, because it's easier to accomplish, it's a great first step. And it's a great first step to creating a payment rail that functions around tokenized instruments that are sovereign fiat. And just making that incremental step and laying the groundwork for this programmable payment infrastructure for others to use is massively meaningful. And I think what you're going to get by having that in place is far better tracking and compliance and transparency into transactions on the network. If you are able to leverage a blockchain, you can build reporting, you can get understanding of what commerce you're powering, you can understand exposures in a way that's real time and much more automated. And so even though this is more of an infrastructure theme, I do believe it's really valuable to try and put in place.
Thank you. There is indeed some value in undertaking things in stages, so the lessons learned can be incorporated. If we now look at the regulatory principles that should be considered when regulating this market, there are three that come to mind that seem needed in an environment that is rapidly evolving and also cross-border in nature. Those are technology neutrality, same activity, same risk, same regulation, and global coordination. But John, my question to you is, are they all possible? What are the risks of trying to satisfy the three of them at the same time?
That's a good question, Montserrat. I think they're all achievable. I think being technology agnostic, I think most regulations are written to be technology agnostic because technology changes. It's true that this idea of shared ledger systems or public permissionless blockchains, for example, didn't exist just a few years ago. So maybe some of the regulations need to be, let's say, updated to facilitate and allow. And actually, that's the approach I think that the SEC is taking predominantly in the United States. They're taking a wait and see approach, and then when new things appear, they say, "Oh, okay, no action letter because this behavior sits actually under existing regulations or licensing," and they have an advantage there, I think. Same business, same risk, same regulation. I think that should apply anyway, regardless of the business. Banks are subjected to high levels of regulation because of the relative level of prominence and importance and potential systemic risk that we pose to society. I think that any other businesses that are operating in a similar space, if that's a globally systemic stablecoin that is similar to what some of the banks do, the regulation should be the same. Does that mean that stablecoin issuers should be forced up to our level, or should we be allowed to, or should there be a separate regime that's set? But that's just a buzzword. Level playing field, right? Large or small, whether you're startup or mature, should actually be achievable. Your last point, Montserrat, what was the last number? No, you gave me number three. What?
Yeah, it was, what are the risks of trying to satisfy the three of them at the same time?
What was the third one? I apologize.
Oh, the third one, sorry. It was technology neutrality, same activity, same risk, same regulation, and global coordination.
Global coordination. Now, this is very challenging. In an ideal world, because shared ledger technology can indeed be global, and we see that with the public networks already, and we may see that with some of the private permission networks, it would be wonderful if there were similar guidelines in the different jurisdictions, not just across the world, but starting in Europe. I have a single ask, by the way. If I could ask one thing, that would be that we have a common standard for what cryptographic key custody actually means and entails, and under what licensing it should operate on behalf of issuers or investors, and just do that once for the European Union, let's say for the 27 countries, as a step towards a single EU capital market. That'd be a wonderful first step forward. To have something similar then expand globally would be great too, but that's a bit more of a lift.
Thank you. I agree. Some of those are going to be challenging, but ideally, because this market is cross-border, we need some sort of coordination on a global basis, and also for interoperability, and also for being able to do transactions cross-border. That sort of standardization seems needed. If we now look at all of these and the impact that it can have on the existing financial services infrastructure, and if I can turn to you again, Radoslav, how could the role of financial intermediaries change in a DLT environment? What potential benefits and challenges could this bring?
Well, especially large incumbent financial institutions have always been viewed as being at a disadvantage compared to new fintech entrants and challenger banks. If you look at, for example, the tremendous growth that companies like Revolut or N26 have experienced, then one of the reasons the incumbents say, well, we can't really keep up with the speed and the technological innovation that they bring is because they start with a greenfield approach, and they don't need to adapt their legacy systems and the huge mass of customers that they already have into a new system. Because transitioning from an old system into a new one is always much harder than starting with a greenfield approach. Now, when DLT becomes a technology that is widely accepted and being used, and there's regulatory certainty around it, then the likelihood that the market as a whole will move away from its existing settlement infrastructure to this new infrastructure is very high, and it's pretty much accepted when we speak with banks that this change is going to happen. And I think for the, especially for the big incumbent financial intermediaries, this is a huge opportunity because they're almost forced by the market to now replace their infrastructure with something new. And it's an opportunity for them to create kind of like a level playing field with new fintech companies that are starting with a greenfield approach. Some of the banks that we're working with that are using our technology in the case of tokenization and for digital asset custody, they started with a greenfield approach. They say, we're not even trying to improve an old outdated system, we're simply switching to an entirely new system. And so this brings them a little bit closer to very agile tech startups. And I think it's a huge opportunity for them to retain customers, to even gain market share, to take away customers from some of their competitors. So for the incumbent banks and financial intermediaries, I think this is a good thing because it opens up huge opportunities. And of course, for the customers and for the clients of these institutions, this is also a huge opportunity because when all of a sudden they can send cross-border payments at a fraction of the cost, at a much higher speed, they can settle securities in real time, completely reduce counterparty risk from settlement transactions. These are all huge benefits that ultimately, of course, improve products and services and reduce costs for the customers and clients of these institutions. So these are definitely some of the main opportunities behind it, and I think the existing financial intermediaries should grasp this huge opportunity that's directly before them right now.
Yeah, clearly there are some opportunities that have been created by the technology, and one of them is the opportunity to do things P2P and in a decentralized manner. This has been, touted as one of the benefits of the technology, and it's also controversial because of the disintermediation part of it. So, Stephen, do EU rules currently allow for decentralization in financial services? And if not, what would need to change for this to happen?
So while current EU regulations are generally technology neutral, they were not written with distributed ledger technology in mind and do contemplate separate parties for trading, settlement, custody, and clearing. And so therefore certain provisions in the existing EU regulation may limit or preclude the use of distributed ledger technology in issuance, trading, and settlement of crypto assets that qualify as securities, particularly those provisions requiring intermediaries. And so, for instance, the Central Securities Depositories regulation requires securities admitted to trading on a trading venue to be recorded with a Central Securities Depository, preventing the trading venue's own distributed ledger, therefore being used as a decentralized record. And so to allow decentralization for crypto assets that amount to securities, exemptions or amendments are needed for certain requirements. However, the new proposed EU distributed ledger pilot framework that Petra alluded to would provide exemptions for trading venues using distributed ledger technology. And so, for instance, those trading venues would be able to request exemptions from the book entry requirement under the Central Securities Depositories Regulation, so that the transfer of a security on the trading venues could be recorded just on their distributed ledger without having to be separately recorded with a Central Securities Depository. And the pilot framework would also allow those trading venues to request other exemptions, such as an exemption from certain of the MiFID requirements on direct access, so that they can directly admit retail investors to trading without using an intermediary. And so it will be interesting to see what other regulatory obstacles that the pilot regime helps to identify.
Thank you. If I can turn now to other members of the panel, do you see financial services moving to a decentralized model? What are the challenges and how should regulators tackle those? If I can start with Lex, then move to John and end with Petrus, that would be great.
Absolutely. So, I gave an impassioned rhetorical point a little bit earlier. I think another analogy that's useful to think about are the evolution of the payment rails. Just because we have a new payment rail doesn't mean all the other ones permanently go away, right? So you can't get into an Uber and do anything with cash. Cash is totally useless in an Uber. And I think for modern financial activity of the 21st century, a lot of things that we use today will be totally useless in the way that cash can't be used in an Uber. And they will be tokenized financial instruments, and they will interoperate, and they will connect all our asset classes, from stocks to equities to real estate to insurance to derivatives, into a single venue. But at the same time, the other rails are equally as important. We continue to use credit cards. We continue to use cash and transactions. In Asia, we use QR codes. In Europe, we use contactless. In the US, I think you write out a check and send it by pigeon. So everything is retained. And I think it's important to look to the future, but then still understand the purpose of the prior venues.
I agree with Lex. I think that the architecture of today's financial industry is one of many banks, many financial institutions, many ledgers. And because of that, we've got a huge network of central clearing parties, CSDs, regulators, reconciliation. The new architecture, the next version of the financial industry, will be one of many banks, many financial institutions, fewer ledgers. And those ledgers will be shared, where the message, the clearing, the settling, the reconciliation, it's all one step, it's fully auditable, and it's automatic. And to me, and as I explained to my senior managers here at Santander, it seems kind of obvious. I don't know why we're continuously discussing it like it's a mystery. It seems like an obvious evolution to make. But we have a huge entrenched, pre-existing installed system that is, made up of large incumbents that are slow to move. And in many ways, by the way, a lot of this innovation we could have brought to the market ourselves 10 years ago. But you know what? It was the crazy world of cryptocurrencies that has shown us the light and the path forward. And I think we have to take the inspiration from there and really use this opportunity to reimagine the architecture of the financial industry. And that's the real opportunity.
Petrus, some quick final remarks.
Well, I think we very much want the possibility in Europe to grasp all the advantages of disruptive innovation and decentralization in this area. In a lot of ways, it fits very much the EU ethos, which is one of multi-level governance, so decentralized governance at many levels, and also of historically giving individual rights to enforce EU law and not just rights to the states. So again, a distributed model. In moving to this, we both want a pro-innovation framework and want to use tools like regulatory sandboxes to adapt existing legal frameworks to the technologies, and then also, where necessary, introduce new legislative instruments like MiCA pilot, possibly something on smart contracts if needed. But something that I do have to underline as well, we don't have a mandate from the citizens to do away with consumer protection or investor protection. So it's not enough to say, oh, it's DeFi, so okay, the consumer just doesn't have these protections anymore, at least the way that the system right now is set up. And I would say as well, the attitude of our democratic societies. So we have to find a way to adopt and adapt and produce these technologies in Europe. And I think this is something that we're also in line with. We have, as we should, conversations with the Securities Exchange Commission, others in the US and other parts of the world. And there as well, they, with a different approach, but they say we need to maintain consumer protection and investor protection. So it's how to do that in this exciting world of DeFi and innovation that is a task for us and the stakeholders together, and we're trying to make our way through it.
Yeah, indeed, those are important considerations. If I can now turn to the questions, thanks to the people in the audience that have sent us questions. The first question I have, I think, is for you, Tetris. Do you think the introduction of a CBDC would mean the end of private digital money?
This is a fairly speculative question, but I mean, if you look at the MiCA draft, which foresees the asset reference tokens, the stable coins, and the payment tokens, this would not be eliminated by a digital euro or a digital yuan or a digital dollar. But of course, it might be less attractive to the consumer, to the user, if this digital fiat currency was available. But that's more a market question than it is a regulatory one.
The next question we have is kind of linked with that. So, I open it to the panel to see who wants to take it. When do you think we will see the widespread use of central bank digital currencies?
I could jump in. I think it will be seen immediately the moment it is released. I think the banks are quite urgently waiting for it. Banks in Germany are currently trying to figure out how to issue digital euros on their own, that they are compatible between different market participants. But I think the moment a proper CBDC is out there, that fulfills the promises and some of the projections that the ECB is making right now, I think it will be very widely used very quickly.
The moment Ant Financial is allowed to IPO is when you're going to see widespread use of digital currencies.
And we have another question on will instant settlement, using DLT ever be really possible? What impact would this have on funding? I'll give my initial take on this. I think this is a very important consideration that needs to be evaluated carefully. It does present some opportunities to have instant settlement, but it does require pre-funding, and it has an impact, or may have an impact, on the liquidity in the system. In some places, some jurisdictions are looking at liquidity savings mechanisms, which is a form of netting that basically reduces that liquidity. I think it will depend on the case, on the use case, and it will depend, how it's being implemented. And it's definitely a trade-off that, you would need to make when designing, how instant that settlement needs to be or can be. John, do you have a different perspective?
No, I would agree. I think if you've got a digitally native asset that has the characteristics of a bearer instrument, where exchange of title can happen instantly, that means the message, the clearing, the settlement, the reconciliation is all one step. You can optionally choose to defer the settlement or have settlement cycles that could be 1 hour, 1 day, 1 week, or whatever, but it can be inherently instant if you choose to use that feature.
I think we don't have any more time for questions. And that brings us to the end of the panel. We have heard very interesting perspectives from the panelists here today. Distributed ledger technology is here to stay and will change the way we do things in some areas. The extent of that change and the time of adoption will depend on the benefits it can bring versus what exists and the number of institutions that decide to use it. CBDCs may be a pivotal factor of adoption in securities markets. Benefits come also with risks that will need to be managed. As any new technology, it may also bring potential disruption and changes in role of some intermediaries. The jury is still open on its future, but it is undeniable that programmable money brings some exciting possibilities. And with that, I would like to thank AFME for the opportunity to moderate this panel, to my fellow panelists for their time and insight today, and also to delegates and the audience for listening to us today. I look forward to see everyone next year, and I turn now to AFME. And with this, I close this panel. Thank you.
Thank you. Bye-bye.
Thank you, Montserrat, and thank you to the panelists for this excellent discussion on creating legal certainty for crypto assets. Again, I would like to thank our partners who have supported us throughout this event, in particular Morgan Lewis and Bitbon, who took part in today's session. Thank you as well for those attending. We look forward to welcoming you tomorrow on our fifth and last panel, where I will be moderating a session on adopting agile work practices at scale within European wholesale markets. Please feel free to stay on the platform and make the most of your networking opportunities using the functionality on the People tab. Enjoy the rest of your day.